If you are watching this because your advisor told you they have your best interests at heart, I need to tell you the hard truth immediately. The model designed for your peace of mind might be quietly eroding the very wealth it promises to protect over decades. By the end of this video, you will understand exactly how a seemingly small fee creates a mathematical trap that no amount of market recovery can fix, leaving retirees with tens of thousands of dollars less than they should have. Here is the thing about money management that most people miss until it is too late. We often assume that paying an advisor for their expertise guarantees better outcomes because we trust them to navigate complex markets on our behalf. But what if the very structure of how these advisors get paid creates a hidden drag on your returns? This is not about bad advice or poor stock picking. It is about a structural friction built into the advisor-driven model that acts as a compounding coefficient against your growth, regardless of whether the market goes up, down, or sideways. Let us break this down with concrete numbers because abstract concepts do not save money, math does. When you pay an annual fee in the range of 0.5% to 1.0%, which is standard for many managed portfolios, that percentage looks trivial on a yearly basis. You might think, well, 1% is just a small slice of my total return. But over a 20-year horizon, that single digit becomes a massive wedge between what you could have had and what you actually keep. The data shows that this drag creates a non-linear wealth gap where surrendering roughly 20% of your total lifetime portfolio value is the direct result of these fees alone. Think about what happens when money sits in an account without friction versus with it. Without any fee, every dollar earned stays invested and earns more dollars on top of itself. With that hidden drag, a portion of every gain is siphoned off before it can compound further. This means you are not just losing the 1% fee, you are losing all future growth potential on that lost money as well. The compounding effect works against you in this scenario because the base amount from which your portfolio grows shrinks every single year due to the fee extraction. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Now consider how this plays out for retirees who can no longer add new income through a salary. When you are working, you have an external engine of capital injection that helps mask these losses. You contribute more money each month, so the 1% drain feels like background noise compared to your fresh deposits. But once retirement hits and you begin drawing from the portfolio rather than adding to it, the fee becomes pure friction with no offsetting inflow. The math dictates that a retiree needs to achieve statistically improbable returns just to break even against someone who pays nothing in fees. The structural misalignment of this model is where things get dangerous for your specific life stage. Advisors operating on an assets under management basis are often incentivized to keep the total portfolio size growing, which can lead to a one-size-fits-all approach that ignores your unique tax situation or risk profile. This creates a failure mode known as inertia, where complexity in fee disclosure prevents you from seeing that your active strategy is simply not generating enough alpha to cover its own cost of execution. You end up paying for the privilege of doing nothing better than what you could have done yourself with low-cost passive funds. There are hidden costs beyond just the headline percentage fee as well. Active management often triggers higher turnover rates, which means more buying and selling within your account. Every trade incurs transaction costs like bid-ask spreads that eat into returns before you even see a number on a statement. Furthermore, frequent trading generates capital gains taxes that hit harder in taxable accounts than in tax-deferred ones. This creates an additional layer of erosion known as the hidden drag, where your portfolio underperforms its benchmark, not because of bad stocks, but because of the mechanical inefficiencies and tax liabilities inherent to active management. Let me put this into a perspective you can feel deeply. If you are facing that 1% annual fee, it is mathematically equivalent to needing to work 3 to 5 additional years just to recover what was lost to fees during your retirement decades. You would have to achieve a return increase of 100% on top of the market rate just to match the outcome of someone who paid no management fee at all. This failure mode remains invisible in annual performance reports because high volatility and strong market years can easily mask the steady bleed caused by these recurring charges. The reason this is so hard to spot is that advisors often compare their returns against other active funds or indices without adjusting for fees. making them look like they are winning when they are actually losing ground relative to a passive alternative after costs. This lack of standardized benchmarking for true alpha means you cannot easily identify the underperformance until it has compounded over many years. The structural design ensures that even if the advisor picks good stocks, the net result often fails to justify the cost of their services compared to a simple index strategy. We must confront the reality that this model creates a situation where your financial security is tied to an incentive structure that does not perfectly align with yours. You want maximum growth and minimum loss. They want assets under management regardless of whether those assets are optimized for tax efficiency or drawdown sequencing in retirement. This disconnect leads to portfolios that may be well diversified but fundamentally inefficient, leaving you vulnerable to the silent killer of compound interest working against your timeline rather than with it. The solution requires a shift from trusting titles and credentials to demanding mathematical proof of net performance after all costs are accounted for. You must ask specifically how much value is being added in excess of that 1% drag or whatever fee applies, not just whether the portfolio grew last year. If you cannot see a clear path where your specific risk profile and tax situation justify paying double the cost of passive investing, then the math suggests you are better off managing it yourself with low-cost tools designed for long-term compounding without friction. The fear that paying an expert is actually costing you tens of thousands of dollars is not paranoia. It is a quantifiable reality supported by decades of financial data on fee impacts. You do not need to guess if the fees are too high because the numbers tell you exactly what they cost over time, and those costs accumulate in ways that annual statements rarely highlight clearly enough for an average investor to catch early. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.